Welcome to the Scalable Real Estate Investing Podcast, where we discuss the most scalable strategies, tools, and approaches to successfully invest in real estate. Learn how to make the most impact of your time, automate your real estate investing business, find off-market deals with minimum time invested, and leverage your capital to create as many income streams as possible so that you can achieve true financial independence. Thank you for tuning in. I'm your host, Mason Clement. Hi, Scalable Investors. Thank you for tuning in to another episode of Scalable Real Estate Investing. I'm your host, Mason Clement, and today we have with us Chris Sands, who is the founder of Sands Investment Group, which is a commercial real estate broker specializing in brokering net lease properties. And to date, they've done more than 1,400 transactions valued at more than $4 billion. So really excited to have him on to go into detail about their approach and shine some more light on the brokerage side of things. So let's bring him in. All right, Chris, thanks a lot for joining us. How's it going today?
It's going great. Thank you. How are you doing, Mason?
Doing good. Can't complain. Things are humming along, you know?
Good to hear.
Yeah. Why don't we just get things started off? I like to ask every guest that's on our show to just go into a little bit of background about themselves. I did mention that you are the founder of Sands Investment Group and everything, but that doesn't obviously do justice on your background. So let's get into that.
Yeah. So I appreciate you giving us the opportunity to join forces today and talk for a little bit. We started Sands Investment Group in 2010, and we are an investment platform that helps both investors buy and sell commercial real estate, primarily in the retail, industrial, medical office, and office sectors throughout the country. We have 6 offices throughout the country: Santa Monica, California; Austin, Texas; Atlanta, Georgia; Philadelphia; and Charlotte and Charleston. We have about 100 people in the firm, and we've just closed successfully close to our 4,000th transaction or property sale in the last 10 years, and just shy of about $5 billion in total volume. But I think those are all interesting numbers, and I only say those just to kind of give you a little highlight of what we're working on our day to day. But the core of really why we started this and what really was the impetus in the creation was working at a much bigger firm in the early 2000s, from 2005 to 2008 or 9. And I was loving what I did in terms of being able to work with investors and help them buy and sell real estate, but saw this void in the marketplace to create an opportunity where a firm was based on a culture that was founded on sort of teamwork and collaboration, honesty, integrity, doing the best for the client and the investor, rather than what worked for them, but then also kind of filled your pocketbook to the best degree. And I found that when you could kind of rewire the program by virtue of taking care of the client and seeking first to serve, then in return you'll always be taken care of, and then creating a mindset of collaboration and teamwork and information sharing, shared database, and kind of having this overall mantra that's one of my favorite African proverbs, which is together alone you can go fast, but together you can go far. We've been really blessed to be able to create what we've created over the last 10 years, and I'm excited to see what the good Lord has in store for us in the future ahead.
Okay, good. And before I forget, can you turn the light on in your room or something? It seems like the lighting, you're in a shadow and it's hard to see you. It kind of goes in and out. I don't know if you can change anything about that, but it's definitely better. All right, perfect. So I realize that your firm website says that you specialize in net leases, triple net lease, and I understand it, but maybe listeners don't. They're not familiar with that. So can you discuss what that is and why a tenant might agree to this type of lease?
Yeah, it's moving in this direction more and more from a tenant to landlord relationship, but from a basic elementary layman explanation, what triple net leases mean is that when you own a real estate property, you have certain expenditures that are including taxes, property taxes, insurance that you have to carry on the property. There's common maintenance that occurs, for example, utilities, right? Electric, water, you name it, the basics. And then you've got also common area maintenance, external maintenance, landscaping, paint, etc. And so what a triple net lease means is that the tenant actually pays for those expenditures. rather than what some people might be familiar with in terms of like an apartment building where they occupy one of the units and maybe they just pay for, their cable and for the electric bill and some water. And then the owners of the building pay for all the rest. In this instance, the tenant pays for all taxes, insurance, all utilities, even sometimes external and common area maintenance. And so from an ownership standpoint, it's very attractive for a investor to buy a triple net lease investment because it allows for a very passive sort of coupon clipper. Some people like to call it mailbox money investment. And the reason why tenants are willing or open to actually doing that is because landlords have gotten privy to it over the years and have sort of said, I don't want to keep doing the reconciliation of the accounting. And since more and more landlords are kind of demanding this is the direction of where we want to go, when a tenant wants a space enough, you can kind of say, hey, this is the lease structure of which we'd operate on a triple net lease basis. And so now you're starting to see it go across all genres. I think eventually you'll even see apartment buildings move to that in the future, just because it seems to be sort of the most simplistic way to be an owner of a property.
Okay, but currently it's just most common with retail. Is that correct?
Retail is definitely the predominant sector that has that. You see it in office and medical office starting to happen more. And yeah, industrial definitely has a version of that. Sometimes it's still what's called modified gross, where maybe the tenant pays for some and the landlord pays for some. The other version is gross lease, and that's kind of where you see the tenant pays for almost nothing and the landlord pays for all. That's starting to become less and less across all product types. So yeah, I do think over time it'll become more equal across different product types. But for now, retail is definitely the most predominant.
Okay, and say if you had like a shopping center and you have common area maintenance, do they allocate that based on square footage rented across each tenant?
Yep. It's based on their square footage that they occupy. They come up with what's like a pro forma version, or their pro rata version, I should say, of the amount of the expenses, and that's what they're responsible for.
Okay, that makes a lot of sense. All right, so on the broker side, obviously you're matching up buyers and sellers. So how does your team go about finding these willing sellers and sourcing these deals?
We have a tremendous, physical inertia that happens in terms of lead generating. So our average broker makes about 400 to 500 lead generating calls a week. We're profiling and researching and creating data lists that we have been able to actuate through, public record information. And then we are making, inquiries to owners with usually something that we've got, either a property for them to buy or a lead of which we have a buyer that's interested in buying their property to kind of get a conversation started. And so, yeah, it's a plethora of lead generating calls is one. We also have a very heavily trafficked website that, thanks to our marketing team and division, we've been able to drive a tremendous amount of traffic to the website. And that's been able to be a good lead generator as well, where owners that are interested in selling will go to our website and then reach out and show it. Will go through the process of seeing if they want to sell based on doing an analysis for them. And a lot of our business is word of mouth, referrals, doing podcasts, doing interviews, et cetera. And then people hear us and reach out because they want to use our platform to be able to help them with the disposition or acquisition of properties.
Okay, so when you're working with a seller, I know it depends on the market, but what's the typical cap rates that you're kind of telling the seller they could expect? And it also probably depends on the property type, but what's your range usually?
Yeah, that's a good question, but it's tough because every genre has like a little different range. But, cap rate is basically just the unleveraged rate of return that you get on an investment, meaning if you didn't put any debt on it, that's what you would get. And so right now, for something that's got a lot of credit behind it, like, let's say a corporate lease, Chick-fil-A or a Chase Bank or something with very strong corporate financials behind it, you will have somewhere in the realm of like a 4 to 5% return on the investment. If it's something that's got less credit behind it, then, like some of the gas station deals or maybe some of these operators that are more franchisee based or backed, then those will usually slip up into like that 7 to 8% return. And so usually we're kind of in a range between 4 and 8%, depending on the credit behind the lease that's backing it.
Okay. Yeah, that was my next question. You mentioned like Chick-fil-A, or I don't even know if they do franchises, but I guess, are a lot of these, they do or not? You don't?
Chick-fil-A does not franchise out. No, but
Okay.
a lot of other operators do. So it's not abnormal. Like McDonald's franchises out they have multiple franchisees. Chick-fil-A they're basically all corporately backed leases. Whereas you can get and let me make this nuance. The lease will always be backed by the credit of Chick-fil-A or McDonald's, but they will franchise it out to operators that own the franchise of that specific store. It doesn't mean that they're on the hook though for the lease. Does that make sense?
Okay.
Whereas you'll see other concepts like Taco Bell out there, and in the real estate market, will have some properties that are backed by the corporate lease by Taco Bell. And then there's others that are actually Taco Bell franchisees that are that sign on that lease for that property. Whereas Chick-fil-A, if you buy a Chick-fil-A today in the marketplace, every one of those leases is signed by Chick-fil-A corporate. And then what they do have is franchisees that they'll franchise out the store, but their financial obligation on the hook is not tied to that in terms of like the operator is not the one signing on the lease.
Oh, okay. Interesting. Yeah, that makes a lot of sense because then that's going to determine, like you said, it's going to impact the cap rate because it's different balance sheets that are backing that lease. So,
Correct.
huh. All right. I have not considered that before. So, does your team use it's obviously a very large country and there's a lot of different markets. So, how does your team whittle it down in terms of do you use minimum populations or certain demographics or certain parts of towns? How do y'all do that?
We have a couple of ways we do it. The company's broken up. Every broker identifies with a certain specific focus, or they become a master black belt, or we call them sort of Navy SEALs of a product type. So we've got a team that focuses on auto and anything within the auto sector. We have a team that focuses on daycares, drugstores, banks, QSR, which is quick service restaurants, grocery stores, you name it. And so with that, it allows them to really focus on anything across the country within that subsector. What you'll find is that there's certain investors that don't mind buying secondary and tertiary real estate, and there's certain investors that only want to buy primary location real estate. And so what's neat about the industry is there's a wide array of buyers for properties, no matter what the subsector is. So we don't really look at something and go, oh, we're not going to work on it because it's too small of a market. It's more of, all right, how do I identify the buyer pool for it for that specific market? And different buyer profiles is really our job, is to go out and identify and give access to that so that owners can maximize the value of the real estate when they want to sell.
Okay. And so could you go into a little bit more detail about your typical buyer profile? Is it private equity funds or individual mom and pops, or talk about that more?
It's for food groups primarily. It's private equity, high net worth finance, private individuals. It's developers. It's the REIT, real estate investment trust, and institutional sector. And then it's actually the tenants themselves. So a lot of the tenants own their real estate, and we work with them to structure corporate finance deals and selling properties that they own and unlocking the actual real estate behind it.
Okay. And I guess the sellers are usually the same type of profile.
Yeah, it's just reverse. Every buyer is a seller is what we kind of say. So
yeah. Okay. Interesting. So the name Sands Investment Group, it kind of at first pass, it seems like maybe you're also investing in things. So does your firm ever take on its own proprietary positions in properties?
Yeah, about 4 years ago, we shifted our focus from solely assisting other buyers and sellers to doing it to equally investing capital with our own money and as well as other people's money. And so we've got started with friends and family and is continuing to expand. And so if people are interested, we do put that out there that we are doing, individual and portfolio acquisitions for properties, and it's basically creating an investment return to the investor, like a preferred return, with some projected returns as well. And so because of our purview in the market and the amount of transactions we've done, we've got a really good pulse on it. And so I think it gives a lot of investors a bit of a leg up in terms of investing with us rather than just somebody who's doing it that doesn't have the pulse that we have because of our entire brokerage community that we've been able to build across the offices.
Okay. So you said friends and family, but you're not necessarily syndicating deals, or are you?
No, we are. We have other people's money. I mean, I say that terminology loosely. It should be anybody. It doesn't mean to be like a bloodline or a neighborhood buddy. It's anybody that's interested in investing, as long as you're an accredited investor.
Okay, so primarily 506C offerings, stuff
Yep.
like that.
Yep.
All right, interesting. So with COVID and everything, I know y'all look at a lot of different types of retail operations, and I feel like it's one that was probably hit the hardest, along with obviously hotels and the travel industry. But how has that affected your deal flow and, well, I guess on the broker side and investment side? Because I feel like it could potentially open up a wide, like a vast ocean of opportunities. But are you seeing that, or what do you think?
I mean, I think that it hit a pretty deep wound for initially, but casual dining, anything where restaurants were shut down, we saw a big pullback. Entertainment, retail, where movie theaters and certain things alike got impacted significantly. But honestly, I think that there was still fast food restaurants that did quick, kind of did takeout, et cetera, that some of our operators had better months during COVID than they have ever before. So I think that it was based on geographically where they were located is how deep it got impacted. And the time frame that it got impacted was low enough that it wasn't long enough that I think we saw a deep enough wound. So right now, with the resurgence of interest and buyers back at it, we're seeing a buyer pool as eager as it was prior to COVID for a similar type product. So I think, casual dining has still got a ways to go before it comes back, with a lot of these businesses still having to have, patio seating, et cetera, and that kind of stuff. But I think in general, retail is always going to be, it could shift from the way we do things now a little bit with the virtual world that we live in. But I do think overall people still, if anything, what's been exacerbated in this COVID experience is how much people demand and desire still human interaction and interpersonal communication. And so with, quarantines across the country, everyone complaining about not being able to get out and socialize and do things that just, I think if anything, it actually showed what the world would look like if we completely became like e-commerce driven only and there was no more retail. I think people would lose their mind. So in many respects, I think actually it's given a little bit more of a birth to the desire of why retail is so important in terms of like our health quotient, just in terms of like getting out and doing things outside of our home and having that interpersonal connection with other human beings.
Okay, so do you see it as, I mean, obviously some retail still has to go away. So do you see it as just maybe a smaller footprint, but definitely still something there?
Yeah, I think concepts will learn how to operate more efficiently and more functionally. But I don't think that the experiential part of walking into a department store will be gone forever, right? And even with movies and entertainment, I don't think that people still thrive to go out and do something on a Saturday night or a Friday night or whatever. And so I just would be blown away if everybody just succumbed to living in their house and doing everything via click a button and working off their iPads. I think that people would lose their mind. And so that to me was the biggest eye opener from the COVID experience that we're still working through.
Yeah, that makes a lot of sense. I think a lot of people have been losing their minds and trying to get outside more, and yeah, on the verge of it. So,
Yeah.
so you kind of hit on this earlier about the impact of COVID depending on the geographic location of the property in the market. But are you seeing certain areas of the U.S. doing better or worse than others, like the South versus North or East West, or what do you see?
I mean, it's interesting you asked that. In that, I think that there were certain hot spots that got impacted with higher rates of, the virus impacting communities. But I think, the Sun Belt markets have always been strong no matter what. Like, I think if you take the southern half of the state, a lot of the country, a lot of the states did fairly well through COVID. But we're selling real estate throughout the entire country, and people aren't, shying away from a good investment property in Illinois or Michigan or New York or the Northeast for that matter. So I think there's sound fundamental real estate is always going to be sound fundamental real estate, regardless of whether or not an epidemic or a pandemic impacted something for a period of time. So I think you got to go back to the intrinsics as to why somebody invests in a deal and really kind of focus on those, and also recognize where it got impacted based on something, whether it was temporary or this is a long-term issue. So, in a nutshell, no, I don't think there was any one area that was like, man, because of COVID, that got obliterated. I don't see it that way.
Okay, or even like on the upside, like, oh, these guys are just, this area is doing really well. Like, I guess you said Sunbelt states.
Florida was like the number one, was the number one, a case state, I think it was for, I think in like May or June with, COVID positive tests. And the real estate in Florida was, I think still is some of the most attractive in the country. So it's interesting. It's not like one correlated to the other, if that makes any sense.
Yeah. Okay.
I would say that like, if you look at a retailer and it was in a market like, Minneapolis, but then you go to some of these shifting, like say take some tertiary markets, like, I don't know, pick somewhere that's sort of, central located in the country, that's more remote, secondary, tertiary markets. And there was like the main casual dining restaurant in that area pre-COVID. I think they would have sustained. There was an investor for those deals. And now I think that's a tougher buy just because like who are the usual suspects that are going to take that space and where is that going to get backfilled by? That's the unknown that investors are being cautious of right now.
Okay. One thing that's interesting that I've heard too, a lot of people have been waiting on the sidelines for the next recession, which is kind of here, the next opportunity. And then at that point, because there's so much dry powder, people are just falling over each other, chasing after these deals, and which could potentially, ironically, hurt returns, even though they were trying to have these gigantic returns. Do you feel like that's been happening at all, or not so much? What's your view on that?
Yeah, I mean, I think there's a ton of money out there right now. And so what happens is when it starts to loosen up a little bit, it seems like, or the market starts to shift, like everyone keeps buying and gobbling up. And so I've read and learned a little bit that a lot of these family offices and like high net worth private equity has been frustrated by the fact that there never seems to be like a tipping point, if you will, where things just keep kind of progressing in that direction because there's so much competition out there that whenever it starts to alleviate a little bit, people start buying and then pricing gets brought back up again. And so that like supply demand game keeps getting impacted, right? And so how deep it needs to go before everyone sort of says, all right, we're going to wait. That's the unknown. And as long as money out there is as cheap as it is, then I think that's why buyers are so interested in using sort of cheap equity or debt, I should say, to go out and buy real estate. That's a compelling story. It's going to be hard for people with the lack of alternative investments out there, in the stock market being so volatile and putting your money in stocks and bonds right now. It's just weird. It's CDs and bonds. It's hard to really say, why would I not utilize real estate as an investment vehicle? So that's what I think is creating sort of this unique moment where it's a very attractive investment vehicle for anybody to be interested in right now, given the returns and some of the positive things that happen from ownership.
Okay. Yeah, that makes a lot of sense. So if our listeners want to get in touch with you and maybe even invest in one of your deals, how do they go about doing that?
Yeah, the best way to do it is, our website is our main attraction. It's at signn.com. They also, I'm first one up on the list in terms of for better or for worse on our about us or contact us when you go to our team. And if they have interest in investing in a deal, by all means, feel free to reach out. My contact information's on there. And we, at any given point, usually have, between 2 and probably 8 to 10 different investment deals that we're working on that are available for subscription or people interested in investing in. So we're always open to new investors and meeting new people and really look at it from a relationship standpoint, not just, helping you grow your money, but it's about like really understanding what your goals are and what your objectives are. And then, from there, trying to help you invest in deals that we believe would match up well with the criteria of what you're trying to accomplish and the goals with the capital that you're trying to put to work.
Okay. And actually, just one more question before we go. You said that your website is a major driver of traffic. So what does your average daily traffic look like for your website?
Daily, Miranda could tell you, our guru, and Kim could tell you, our marketing gurus. I know that we probably get somewhere, I don't know the total number. I'd have to go back and look, and it'd be probably uneducated for me to speak to a specific number. But I just kind of go off of like organic search and where we rank without, doing sort of paid per click stuff. And, we've been fortunate through our sort of traffic and organic keywords that we've been able to kind of be on the first page right underneath sort of, your paid ads. And so again, I'd probably have to default to my team to know exactly what the number is, but it's a lot of people and we get a lot of good foot traffic through that either are buying property from the website or through, getting interested leads that end up generating through a lead through the website or, end up calling us because of it to say, hey, I'm interested in doing something. And we either invest with them or they end up selling a property through us or buy one as well.
Okay. Cool. Yeah, just curious. It's always something really important in today's online world. So very good. Well, thanks a lot for taking the time to discuss everything with us here, and maybe do it again soon sometimes.
I would love that, Mason. Thank you for your time, and you had a great podcast, so keep up the great work.
Thanks.